You're watching The Plot right here on ausbiz. Now, with the rise of private credit funds, how do investors know just which one is the best fit for them? Well, Paul Miron from Msquared Capital joins me now to take us through the detail of it. Look, Paul, I think last year we went through very quickly from private credit being really hot to some warnings about maybe a bubble is forming. Where do you stand when it comes to what the market is like?
Well, there's a lot of things happening right now. We can look at macroeconomic at the moment. Private credit really came into the scene because people were realizing what the positive attributes of private credit is. It can give you a very stable income in very volatile times. Plus, with the interest rates going up as well, it put a lot of other asset classes at a heightened risk. But there is still risk in private credit, and investors need to know what they're investing in. Now, private credit covers such a huge variety of different types of mortgages. And investors have to be understanding of what is the fund manager doing, what is a fund, what's the quality of assets in that particular fund as well. So those are the real key attributes that need to be really looked at very, very carefully.
Yeah, you're right. It's such a sweeping statement, isn't it? But also, it's getting a lot of press, especially when you've got Australia's super funds also exploring that asset class. Of course, we're specifically talking about private credit with real estate foundations, right? Before we get into that, I want to get your thoughts on the interest rate now. When you're talking about volatility, this of course being driven by the rates. Where do you stand about, are we going to see cuts? Have we hit the peak?
Well, the market is quite euphoric in relation to the probability of having a lot of interest rate cuts this year. So in the US, they're predicting between 3 and 5. Now, we haven't seen the bottom of inflation yet. And it doesn't take much for those expectations to be changed very quickly. Now, inflation could be bouncing on the wrong side of 3, and we might not see the cuts for a while. And we need to remember how monetary policy works. The current state of interest rates are there purposely to deflate the economy. So businesses and households are deleveraging at the moment. Now, if we don't get those cuts, then that soft landing that we're all hoping that we will get won't be as soft as what won't turn into reality. That's really what the risk there is. But when we talk to private credit, it's quite interesting because whether we have a hard landing or not a hard landing, there's different private credit, and Msquared is what's called a secured private credit lender. Every single loan that we offer our borrowers, it's secured by property. And more importantly, the type of security that we actually want for our book or from a credit quality is liquid, non-specialized security. Now that is a very key aspect because private credit at the moment, that you're looking at a lens from the fact of how big your gearing is, and what's my return. Now there's a lot more to it than that. There's about the quality of assets behind it. And so one of the things that we are looking at the market and thinking there is a significant risk in asset prices or property, even though property has been very stable, is specialized security. I can give you an example. So, for example, specialized security is development sites. It could be childcare centers. It could be any value to a piece of land that's attributed to a particular business. Now, let's say a pub, for example. A pub is trading really well, and all of a sudden, overnight, for any economic reason, or might be a competitor across the road, that pub might not be trading as profitably. The tenant moves out. You're left with the real estate. What's alternative use? Do you value the asset with a pub? Well, if there's no other publican wanting to run the pub there because it's not profitable, where does the value go? So when you're looking at these specialized security, what's alternative value? And we haven't had a market, we haven't had a time period for a very long time that those type of assets have been tested. So we stay quite clear of it. So from an optic perspective, you might have a fund that you're looking at that might have a lot of rural land and farms which haven't had any issues. It might be a 20% gearing, but those assets could actually fall a lot, and you might not get your money for 3-4 years.
Yeah, for sure. I think that was what I was trying to get at when it comes to the interest rate, because I do understand that some of the private credit asset classes that are based on something else that is not property might be a little less exposed to the interest rate changes, but property is exposed. So in terms of the kinds of properties that you look at, what kind of exposure does it have to the changes and fluctuations in interest rate, as you say, looking at the market, and you don't know what's ahead. So how do you prepare for that?
So that's a fantastic question. So from a conservative perspective, when we look at security, and someone comes to us with a proposal, we're very comfortable not lending more than 60 65% of the value of that particular security. So therefore, the property market would have to fall more than 35% for the in the worst case scenario, unlikely situation where the borrower can't pay, for us to be able to recover, for that investor to lose any money at all. And so these are the fundamentals of what people should be looking at, is that not only the gearing, is that what type of securities there are, and then you're making an assessment in your mind to say, well, property has never fallen more than 35%. So that is why, in a very volatile market, in very bad periods of time, you have that consistent income and you can rely upon it as well. So it's all about limiting your absolute negative return on anything that you do and having that compounding effect of your portfolio.
By nature, are private credit funds that are rooted in real estate, do you think by nature you're more conservative, or you, as in your specific fund, takes a more conservative approach? Or so what is it? Is it just a generally private credit takes a more conservative approach?
It's very important for viewers to know that there's always a risk, and it's for them to actually know as well. So the different fund managers and different managers will take on different type of level of risk. So what we have done in our business very well, we've listened to our investors, and we have a very strong cohort of investors who don't want to have exposure to construction or specialized security, and they are very comfortable of any mortgage that we lend that their money is associated with is not more than 55%. And that is why we actually created our conservative income fund, which gives that ability for people to specifically choose the risk they want to have. That currently is returning 7.8%. The average gearing across the entire portfolio is very, very, very low. It's 55% at the moment. But if you do want to have slightly higher gearing, you want to have slightly exposure to different type of mortgages, then we have the high income fund that's offering 10.3%. So it's all about giving the right choice to the right investor for exactly what they're requiring to be part of their entire portfolio. And we're not saying that you have all your portfolio there, but it's important for people to consider a part of the portfolio that they know that they can have a consistent income through a longer period of time. So it works really, really well, a part of a larger diversified portfolio.
Yeah, and can you remind us again your specific fund on the minimum investment and the time frame that you're looking at? I know we talked about this last time, but let's just have a refresher on that.
So it's minimum $100,000 for our two pooled funds that we have, and the liquidity is within it's locked up in the first 12 months, and then you can actually withdraw it on a quality basis.
And before I let you go, maybe looking ahead, because of all this talk of is there a bubble in private credit, what is your perspective on that?
As long as you are
bubble
secured.
Forming, let me correct you.
Bubble forming. Look, I think we're entered into a more conservative period of time. The loans that you have to be worried about are the ones that were written in the good times. I think the loans that are being written right now are a lot more conservative than were done 2 years ago. Saying that, you still need to investors still need to ensure they don't have too much exposure to those loans that were written 2 years ago when the economic situation was very, very different.